Welcome to New Money. I'm Bryan. This evening we are focusing once again on the investment world. It is well known that investing to achieve long-term growth is not about timing the market. It's about time in the market. There was not a month that passed last year when most investment commentators were not assuring investors that cash was king. There was more cash sitting on the sidelines waiting for someone to ring a bell when it was time to get back into the market. How wrong they were. Here's a slide which I'd like to explain. Come up with the first slide. This slide shows you very simply about markets. The line going up in green talks about markets moving up, and when fundamentals and sentiment are positive, markets move up. The line coming down and hard for me to see, but in red is showing declining markets. When fundamentals are negative and sentiment is poor, markets come down. The trouble is when there's volatility, when sentiment and fundamentals are very much out of sync, then you have that volatility which you can see the jagged line. The point I'm really making that is you've got to understand that sentiment in most cases drives daily market performance. What the news is of the world, all the bad news, and how it's going to affect market. Joining me this evening is David Shapiro, Chief Global Equity Strategist at Sasson Wealth. David, good evening. Lovely to have you back on the show.
Thank you.
I hope you had a good December, good all the very best for the coming year. David, I want to put up a slide that you and I have been talking about, and if I may just ask them to please up slide 2. This is a slide you gave me on the 10th of November, which shows the composition of the JSE. I'm going to let you talk through the slide, and then on the following slide, I'm going to talk about how one would have expected in performance to have been following this information. Please talk through the slide.
It's actually a remarkable slide. And in fact, very few people understand the composition of the JSE. And what I try to illustrate is that today, the market value of the JSE, in other words, the market cap, that's the value of the shares on the JSE, 71% of the value is made up of companies who earn less than 25% of their income in South Africa. In other words, 75% of the income that these companies earn is outside. So for all intents and purposes, the JSE is a rand hedge. It's very much so. And what I've tried to do in the slide, you can see this, I've identified some of these companies, BHP, Process, AB InBev, etc. In fact, I want to say one thing. I'm very generous with that 25%. In fact, it's much less than that. So the JSE is really composed of international companies. If you take that blue slice away, you'll see over and above that there are a couple of, there's still miners. So there's still Anglos and South 32.
In the orange slide, 11% is miners.
And they earn dollars. They all earn dollars. Why I put Anglos in there? Because they've got Anglo Plats, they've got Kumba, so they've got quite a few South African miners there. But they still sell their product in dollars. So again, you can add 71%, you can add the 10% to 71, so 80-odd% of the JSE is dollar-based. The earnings are dollar-based.
So David, why I put that slide up? Because we're going to come to the next slide now, which indicates if our South African market is really an international market, why didn't we perform as international markets do? So let's just bring up slide 3. So now, David, let's talk about particularly the yellow line and the blue line.
That's the conundrum. People don't understand this. And what this illustrates is that even though we were a rand hedge market and that the rand did very badly, so did we. We never performed. And the reason is that the US market is composed of what we call the Magnificent Seven. I've altered that slightly.
It's really the Magnificent 15, isn't it?
Yeah, it could be. It's the tech. And what we saw almost from 2009, from 2010, was the tech revolution in the United States. And this was after the great financial crisis. We suddenly saw tech take off. What were the initial drivers, Bryan? Initially, it was social media. Facebook and Google and Instagram and YouTube and all of those. Subsequent to that, as that was slowing down, and this includes the 2020, the COVID, COVID's an important period. Sorry, I must mention. Why is COVID an important period? Because during COVID, everybody bought more cell phones and they bought, computers. We started to use Zoom. As that died down and we came out of COVID, we've suddenly got the new revolution, which is the AI revolution. So we've had these three movements almost, which have absolutely elevated US markets beyond the reach of other global markets.
So David, when we look at the slide and we look at the green line shows in dollars what the JSE has earned over that 10-year period.
Yep.
And the blue line is the American market.
Yep.
So very simply, David, where would you want to invest for those who are looking for growth?
Well, I don't think you have to be a genius. You don't have to be Einstein to. Okay, the question is where to from here, and I think that should be the basis of what we start to discuss in the year going by. Can those other markets catch up? Can the South African market catch up? My answer is it's going to be very difficult, simply because we haven't got that economy. There are a whole lot of factors. I don't think we've got the right time. We might take bits of it, but I mean, we're going to struggle. What's interesting there as well, Bryan, is that I put the FTSE in, which is the UK market. And the UK market is almost a clone of our market, or we're a clone of their market, because both markets have got a lot of the miners in. The Anglos and the Billitons and the Rio Tintos. We haven't got Rio, but Glencores and so on. They've also got energy stocks. They've got a lot of Royal Dutch Shell, what's it now, Shell, and also a lot of financials. So UK is going to find it difficult to struggle. Europe's doing slightly better because it's got luxury in, and strangely enough, there are quite a few tech stocks that are coming through in the Netherlands. But America is just running away with it, and I think it's going to be another decade of growth in the US. The US markets are going to outmaneuver all of them simply because of AI, of artificial intelligence, and the spend that's going to be the whole supply chain for artificial intelligence is going to dominate global markets.
So David, you're not really convinced the fact that you're in the South African market, and I keep making the point for growth, because there's no doubt about it, in South Africa, if you need income, this is the place to be. I mean, if you look at government, we'll talk about that a bit, but how your view on government bonds and so on. But certainly, are you not convinced that being in the South African market, invested in rand hedge stocks, you're going to get that you're going to get that performance? As you're
putting me on the spot, because I'm unapologetic about it. And I always say, I'm never influenced by the rand. I'm not influenced by politics. I'm not influenced by any of those factors, only opportunity. And the more I look at artificial intelligence, there are other themes as well. This whole transition of energy, the renewables, electric vehicles. The more I put those themes together, the more I'm persuaded to stay with America and to stay with the company. So this is a matter of choosing the right stocks. And if you can find something that can challenge them, by all means, go in. That doesn't mean that you're not going to find opportunity in South Africa. I'm sure there are going to be shares that pick up, from a very low base as the economy starts to improve, as we start to bring on power, hopefully get Transnet under
interest rates start to fall.
Very, very big factor. Very big factor, yes. Then there will be opportunities within the South African market. There are going to be a lot of arguments. I'm going to find people to say, wow, the American market is too expensive. This is much cheaper. Yes. There might be validity in that.
So David, when they talk about the Magnificent Seven, and for those who don't know Magnificent Seven, the Nvidias, the Amazon, the Apples and those type of things, in 2000 we had the bubble burst.
Yes.
And even Warren Buffett said at that point in time, I don't invest in industries I don't understand. No. Now, the comment is everyone's saying, well, the bubble's got to burst on the Magnificent Seven. You're saying.
When the bubble burst at the turn of the century in 2000, which was the internet bubble, these were businesses that weren't earning money. They had nothing underneath it. They had promise. In this case, if you look at the Magnificent Seven, they're very, very muscular. They're huge. They're large companies that dominate the investment, not only investment landscape, the business landscape. So they are making huge money. And where they've got the advantage is that they're reinvesting those in more products. Because they're generating so much cash, they're not giving it away, they're not paying any dividend. They reinvest it in actually continuing to develop their product. NVIDIA is an outstanding company. I mean, if you could show an individual chart on it, this has gone through the stratosphere. The problem is that they make chips that you absolutely need if you want to install AI onto your into your business applications and that. And they're way ahead of the opposition. Opposition will catch up sometime. There's a very good article this week in The Economist on ASML, which is the Dutch company that makes the machines that makes the chips. And and what it does show you, and that's why I added it to my Magnificent Seven. I've taken Tesla out and I've put ASML in.
David, just coming back to artificial intelligence and how you're going to use it. I mean, one of your big advantages, you see results.
Yes.
But because of all the commentary you do, you need to understand those results. You need to read what's not written. You need to understand, interrogate those results. Is artificial intelligence going to replace this knowledge that you need to spend so much time daily assessing? Okay, I've read the results, and I've actually got an interesting email from someone that's spoken to me about Wells Fargo, which we'll deal with in the next segment. But is that going to help you more? Is it going to speed up the information that you're going to get?
It's going to be ubiquitous. It's going to be widespread across. It depends on how you use it. But I think where it's going to be an advantage in trying to translate it into easy to understand language is that it's a common language. So what they've done is they've taken these complex machine learning computers, and they've created a language which allows you to interrogate it or ask it a simple question. And what you should have done today is you should have gone into AI and said, write my script, and would have given you said, these are the points I want to bring, and it will write a script for you.
That's going to make my life that much.
Totally. If you want to write, give me a letter to a customer who's been insulting me. This is what he said. And they'll give you the best. But there's more than that.
David, let's come back to that. We've got to take a short break. Stay tuned, and please stay with us till we return.